The company I'm about to present to you today, which is also a Warren Buffett's position, is extremely interesting right now. Its stock price fell about 60% from recent highs and got to a very compelling valuation. It has super high growth, great management, and a huge buyback plan that might create a very rapid appreciation of the stock price by buying back up to 50% of the adjusted float. The recent bear market created a lot of very compelling investment opportunities, but not every stock is going to outperform the market. And that's why I decided to make this new mini-series to investigate stocks that got beaten down and in result offer a great risk-return ratio. I'm not going to blindly hype you up about stocks. I'm going to analyze both the bull and the bear case so you guys get a better understanding of whether there's a compelling risk return here. So is the company we are about to analyze today offer that great risk return we are looking for? Let's find out. Okay, so the company we are about to analyze today is RH, or Restoration Hardware. If you don't know what they do, I will briefly explain it and what's the business plan. If you are familiar with RH, I will probably talk about some things you already know, but stay with me. The juicy parts, valuation, risks, and price dynamics will come right after. So what does RH do exactly? They are a luxury brand for furniture and they have those amazing looking galleries, and in some of the galleries they have beautiful restaurants. Everything is very luxurious, and when you enter an RH store, you get the vibes of a Disney palace with price tags that could probably make some of you consider a career change into selling luxury furniture. Right now they operate mainly in the United States and they have 63 stores in the US and 4 stores in Canada. What's interesting here is that the management has plans to expand into Europe and eventually to other places globally, which they believe could unlock a $20 to $25 billion revenue opportunity in the long term, compared to the current trailing 12 months revenue of $3.75 billion. There's a huge top-line growth potential upside. According to the management, RH is currently in advanced stages of opening a new gallery in London, Paris, and many other locations around Europe. And there is a lot more room to expand in the US as well, so if they manage to expand successfully, that could unlock a massive potential for the company. I will show you by the end of this video exactly what this kind of expansion could mean to the P&L and the stock price of RH, and the different scenarios in my model for their expansion success. They also have a new furniture line named Contemporary, which is a huge deal for them, and the management believe will be a big growth factor. By the way, did I say RH is a furniture company? Well, it mostly is, but it's not the only thing they do. They started to enter many other luxury fields like restaurants, guest houses, and traveling. They also acquired 2 planes and a yacht that will be available for charter. The yacht already is available for charter and the planes will be available later this year. 13 of their galleries already have an integrated hospitality experience and they aim to open their first guest house in New York this year. It seems to me like they have a grand vision to make RH a synonym for luxury, not just for furniture. It's an interesting idea. I don't know of any other company that try to achieve what they aim to achieve in the same way, so it's hard to assess how hard it will be for them, but clearly, if they manage to execute on their plans, there is a massive potential here. And remember, it's nothing like those companies with unexperienced management that we know nothing about. This management is the same one that made this company what it is today from a $20 million company 20 years ago. It doesn't mean they will succeed to execute their vision, but it makes it much more likely. Personally, I like to invest in founder-led companies, usually because it means the management already knows the business inside out and hopefully deeply cares about the company they built, unlike some hired CEOs that are solely in it for the money. Gary isn't the founder, but he is in this company from the very early stages and he did make it what it is today. So as I have said, there's a lot to like in this company, yet for some reason the stock went down 60%, and as part of our analysis we have to understand exactly why it happened and if there's a good reason for that recent horrific price action. So obviously there are macro concerns surrounding every discretionary retail company, and one of the main arguments of the bears here would be that the first thing customers would cut out of their budget in a recession would be luxury furniture. We will talk about it more in a minute, but the thing is, the macro concerns here are getting a very strong support by the CEO himself, who seemed to be pessimistic about the short-term future of the company because of the macro environment. And some people think he makes those claims just to make the stock price drop so they can repurchase it for a lower price. The company just announced a $2 billion share repurchase program after they took a $2 billion debt earlier this year, which is more than a quarter of the current market cap of the company and around 40% of the float. I'll make a video on that topic in a few days because there's a lot to show you to determine if they are right that the CEO is pessimistic just to buy back the stock. It is not the first time they are buying a massive amount of their shares. In 2017, they bought back 60% of the shares outstanding, and they did it just in a few months, which is crazy fast. There are many similarities to what we see today, and in the next video, I'll show you everything you need to know about this buyback program and if he really is over pessimistic just to buy back the stock. For the current stock price of $245.44, the company has a market cap of $6.62 billion. But if you reduce the shares outstanding according to their buyback program at a cost basis of $400, which seems plausible, you get a market cap of $5.4 billion, which implies a trailing 12-month price to earnings ratio of 7.1 and price to free cash flow of 12.19. Considering the $2 billion in debt they took and the cash they have on the balance sheet, they have an enterprise value of $6.74 billion, which means trailing 12 months EV to earnings of 8.9 and EV to free cash flow of 15.2. Over the last 5 years, the management was able to consistently improve their gross, operating and net margins. They have a gross margin of roughly 50%, operating margins of 25% and net margins of more than 18%, which is very high for this industry. Taking all that into account, with the amazing potential this company has, the valuation seems very compelling right now. And take a look at this potential outcome sheet I made for a 5-year period. I modeled the potential store opening rate and the average revenue per store, which is likely to go up since they enter new markets they are not currently at. You could argue that every new store outside of the US is opening a whole new country market, which might create a higher revenue per store. But in my low model estimates, I actually discounted it from the current average revenue per store, which also sounds like a reasonable outcome given that they are entering new markets and they have to start there from zero. Even if they succeed their expansion plans, it might take a long period of time to reach the same success they had in the US. You could also argue that they might completely fail with their expansion plans, thus creating a larger downside. The average revenue includes the e-commerce revenues to keep things simple here. When I model my worst outcome, I get to a negative growth rate of almost 2% year over year and an EPS of $19.39 or $22.9 adjusted to the buyback program. And for an EV to earnings ratio of 11, I get to 32.9% downside. That could happen in the scenario that the contemporary line is a failure and their global expansion is also a failure. It could also occur in the scenario where there's a very mediocre success with their global expansion coupled with recession-driven deceleration in their current US business. In my base case, I get to 4.8% growth rate a year and $32.5 EPS. With an EV to earnings ratio of 19, I get an upside of 170%. Remember that if the company is successful in the next few years, it will probably get a better EV to earnings ratio from investors. That's why there's a difference in this ratio between the scenarios I modeled. The base case could happen if the contemporary line is successful and the global expansion is somewhat successful as well. In my bull case scenario, I get to 9.11% revenue growth growth rate a year and an upside of almost 478% with an EV to earnings ratio of 27 and an EPS of $44 before the buyback. So by my model, there's a 33% downside with a huge upside. But there's always the possibility that I was too optimistic. There's also a chance that given the upcoming possible recession, luxury furniture sales will drop significantly, thus creating a much larger downside scenario. I will talk about the possibility of it in a minute. You can play with the numbers yourself and maybe we'll get to something very different from what I get. And remember that it's a 5-year model, so it doesn't mean it won't go lower than 33% in the short term. It's very likely to happen in this environment. And you know, limited downside companies with a huge upside are what we are looking for right now. Great companies with great management, performance and potential that got hit hard in this bear market. And we have many more companies we are looking at right now that look very interesting. So make sure to subscribe to get notified when we release new videos about those companies. As soon as we release the next videos of finding gems in a bear market, we will put a link down in the comments. Let's talk about long-term and short-term risks for RH. They are expanding to the European market, which could be a great opportunity, but we haven't seen yet how well they could expand there. Remember that they are a luxury brand and Europeans are known for their dislike of American luxury brands, so it could fail there and we don't have enough data to determine that now. It's important to remember that RH's results over the past year were affected by massive demand fueled by the Fed's money printing machine. The bear case would be a softening demand in current markets and a very bad macro environment for expansion that could result in huge losses instead of the massive top line and bottom line growth rate the company aims for. I mean, think about it, you're probably not going to see a lot of people saying to their wives, "Oh honey, I might lose my job next week. Sounds like the right time to decorate our entire house for $200,000. What do you think?" No, probably not very likely to happen. And other retailers like Walmart and Target already started seeing softening in demand, particularly in furniture demand and a very large increase in inventory. So it makes a lot of sense that we will see the same trends with RH very soon. We haven't seen yet anything like that with RH, and they had great Q1 results with 11% revenue growth from last year and a GAAP EPS of $12.16 compared to $4.19 last year. They also reported an adjusted EPS of $7.78 compared to $4.89 last year. But it doesn't mean we won't see the macro effects on RH soon too. And the management did guide down for the next few quarters. Target also just announced plans to offload excess inventory, including furniture, and it had cut its Q2 earnings forecast, so it's possible it will also happen with RH, especially when the CEO says they already see a softening in demand. You can also see in this graph that luxury spending decreased globally during the last recession in 2008 and 2009. So we could potentially see the same thing in the luxury business now if we enter a recession, and that could affect RH sales, at least in the short term. If you are here for the long term and you believe in this company's ability to execute, it might not worry you, but it's never pleasant to invest in a company a minute before it experiences bad times. You can also see in this document from Tel Aviv University that they found that furniture is one of the categories that are more likely to experience reduced demands in a recession, with a 10% decline. Another thing that's a little concerning is that the CEO Gary Friedman said in the last earnings calls that they benefited from the mass of Americans moving from the cities to the suburbs in the last few years, because people have larger homes in the suburbs and they need more furniture. And I don't know how long this shift is going to last. If this shift will slow down, they could see a decrease in their growth. One more thing is the contemporary line they just released. There is always the risk that it will not be as successful as they think. I actually think they will do alright there, but it's always a risk with a new product. The last thing here is the vision. As I said, it seems like they are shifting slowly from a luxury furniture brand to a luxury luxury brand in general, not just in the furniture business. And that's not something you see a lot, so it's hard to tell what their chances are to succeed in fulfilling this vision and how hard it is. Overall, I think the potential for the company is very high and the stock price seems like a good opportunity, but there are short-term and long-term risks here, so if you think about buying this stock, think how much risk you are willing to take. If you want to learn about another stock that its stock price dropped significantly in the last year, check out this video where I go through my perspective as a game developer of Unity. Thank you for watching. If you like this video, I'll appreciate your thumbs up, it helps us a lot with the YouTube algorithm.